Our next speaker is joining us from Hong Kong, Vanessa Chan, Asian Fixed Income Investment Director at Fidelity. And Vanessa is going to focus on the Chinese bond market. So we'll continue the discussion here about interest rates and the fixed income area. Welcome, Vanessa. Hi, Vanessa.
Hello.
Hello there.
Hello. Hello.
It's late work for you too this evening.
Yes, it's probably close to 9 p.m. in Hong Kong already.
Okay. So this will be the last thing you to do for this working day, or do you work in the evening always with European contacts?
Yes, only for the European clients.
Okay, I guess. Just for you, we have here a room of participants here. We also have online viewers. Both of them can ask questions, and they will ask questions. But I'll leave the presentation to you. You have a poll somewhere in the middle. I'll explain that when the poll comes up, how to give your opinion. But I'll leave it to you here. Vanessa, please, you can start.
Thank you. Good morning, everyone. Thank you for having me today. I do have some slides. What I'll quickly do is to recap in terms of what are we looking at for China fixed income market, and then going to a little bit deeper of what's been the recent development of the market, so that we can also have some discussion and question and answers towards the end as well. If we move on to the first page, what you see is that why are we thinking of the fixed income market in China? So A, B, C for China bonds would probably be where I would start on page 4. So first of all is the A's market. It's one of the largest and fastest growing market. It's also a very broad market where you have a broad range of instruments available. And finally, there are different ways that investors can get access to the China fixed income market. Next page.
You're going too fast here. We have some
And
delay. Probably the long
up.
distance we have a delay for. Yes, maybe next slide.
Yeah.
This one you were talking about?
Yes. And then if we go to the next page.
Okay, yes. Thank you.
Thank you. Then you will see what I was talking about in terms of the A's market being one of the largest and fastest growing market. If you zoom in, what you see is that the market has doubled itself since 2015, and we do expect the whole market to continue to double itself again in another 5 years of time as well. And then on the right-hand side, you see the inflows that we have been getting since 2014. Historically, this was about 2%. This is only related to Chinese government bonds, i.e. bonds issued by the Chinese government. Back then, it was about 2% in 2014 for foreign ownership. This has picked up gradually. That's really on the back of index inclusion that have been gradually announced in the major indices. What you realize that is depends on what indices you're looking at, be it a global aggregate index or EM index. The percentage of allocation based on that index would potentially range from 5% to 20% for some of the EM indices as well. So that's why you see the flows continue to be quite high in terms of China, and at the moment we're looking at about 10 to 12% of the Chinese government bond is owned by foreign ownership.
And 60% by the domestic banks. I'm just explaining a little bit because the slides are not too big over here, so and I'll just try to explain a little bit, but you might do as well.
Okay,
Okay,
sure.
thanks.
If you break down that ownership, you'll see about 10 to 12% by the international investors, and around 60% is actually owned by Chinese domestic banks, and probably around 12% by mutual funds, and then there will be other participants owning about 17%.
Thank you.
You will see the broad range of instruments that we're talking about. The Chinese government bond is only part of the universe. There's also other choices. Some of them which get commonly talked about is the green part. We call it policy bank bonds. These are bonds issued by banks that is directly state-owned, and they have a policy reason behind this bank. So, for example, Development Bank of China is one of the policy bank, and the the policy bank is also part of the index inclusion for some of the global aggregate index or even EM index that you talk about. There's also a big part of it called the orange part is the local government bonds. As you can see, this is also providing part of the local government financing. This you probably will need to look in a little bit deeper in terms of the standalone credit of this local government, whether they're strategically important, and that will probably be the major part of the 13 trillion US dollar onshore bond market. Having said that, there's also other peripherals that you can consider. There is the offshore US dollar dominated bond market, which is about 1 trillion US dollars. And there's also the dim sum bond market, which is an offshore CNH market based in Hong Kong, which is around 37 billion US dollars.
Vanessa, is there a reason, Vanessa, if I interrupt you, is there a reason why the local government bonds have grown that fast in the last, say, 5 years? Because they were almost non-existent 10 years ago, and now they're a big portion of it.
Yes, I think one of the reasons behind it is that there has been more needs for local development, more need for local financing, and be able to issue bonds also help in terms of the local government to finance themselves, especially if they wanted to engage on more infrastructure projects as well. So that's really one of the key reasons behind it.
And if I can ask another question, are these local government bonds backed up by the central government?
No, they are not backed up by the central government. Individual of them will get an onshore domestic rating. Actually, most of them will not have a offshore international rating. What we'll come later on to share with you some of the credit differentiation and how ratings differs between the onshore and offshore market as well.
Okay, thank you.
Thank you. Next page, we talk about the different channels. I think the previous presenter have talked about Bond Connect, and indeed Bond Connect have made it a lot easier for international investors to participate in the onshore market. But if you look at the next page, I think what we wanted to focus on is the different ways that investors can think of in terms of accessing the market. On the left-hand side, you see a slide with some of the efficient frontier. This is very simple. All we did here was adding a different percentage of CGBs, i.e. the Chinese government bond, into a global aggregated portfolio. What you see is that by adding 1%, 2%, and 3%, it's actually pushed the efficient frontier lower in terms of volatility, whilst you still maintain a fairly steady or healthy total return. So by investing or by adding on China CGBs, China government bonds into your portfolio, it does help in terms of diversification benefits as well as lower the overall volatility of your portfolio. This is probably similar to what the previous speaker mentioned. This is the kind of rates exposure that a lot of foreign participants have been exploring recently since 2015, 2016. On the right-hand side, this is a all China fixed income strategy approach, i.e. the investors are not going to worry about asset allocation. They're not going to think about whether they're putting money into rates, credits, banks, onshore market, offshore US dollars, or offshore dim sum bond market. They're engaging an active manager to invest in China fixed income overall. So they will have coverage in all three markets. And what we have shown here is that the performances of this fund could be quite steady and quite healthy compared to the different indices in the market. So an all China fixed income strategy will be in the blue color, whereas if you see the dim sum bond market index is in the red color, i.e. the offshore CNH market. And then you have the yellow, which is the onshore broad market indices. And the green is the offshore US dollar bond market indices. So a blended approach, in our view, do offer more stable and consistent returns as well. Okay, now I'll move on to the next page. So we're going to share with you some of the latest in terms of the China bond market. And before we do, we'll have a quick poll for everyone as well.
Okay, well, if you can go back to the poll, I will explain this to the audience online and over here. You have to go to menti.com menti.com. And you have to fill in the code you see there, and you can give your opinion on why invest in China bond markets. One, because of valuations, two, diversification, three, the local currency, four, any other reason you can think of. And we'll go back to this later, because we don't have the results straight away, Vanessa.
Okay, sure. Then I'll probably move on to share with you what are the key reasons. So first of all, I think the attractive risk-adjusted return, next page. Okay, so we talked about, I think earlier on there was a question regarding why think about China in terms of this low rates environment. One of the key attributes of the China government bonds is that if you look at it from a currency basis, that actually offer relatively attractive yield. You're talking about 3%. That's in local currency basis, i.e. you are holding renminbi. And then if you look at US dollars, UK, Germany, and Japan, you're looking at much lower standalone interest rate to begin with. So other than the interest rate, on the right-hand side, we also have the China bonds Sharpe ratio for past 5 years compared to the key major asset classes. It's a little bit small here, but I will kind of go through everything in the blue shaded box. So the highest one will be offshore renminbi bond, i.e. the dim sum bond market, which is one of the smallest, 37 billion US dollars. But this market, one of the unique features is that it's very high quality credits. A lot of them are actually quite stable. And then a lot of the owners actually hold these bonds till the end of the maturity, and they don't trade very much. So that's why the volatility is relatively low. Liquidity, interesting, is also quite satisfactory, especially because a lot of the holders are actually banks that have a significant deposit in renminbi. And then if you move down the the blue box, you'll see onshore renminbi bonds. And that probably will give you around 1% in terms of Sharpe ratio. Whereas if you look at the offshore US dollar option, both in terms of China high yield and China IG, what you see is that this will also give you about 0.3 for high yield, given it's probably a little bit more volatile compared to the IG asset class, where IG will give you about 1 times in terms of Sharpe ratio. So if you think about the all China strategy that I was talking about earlier, why is it performing better compared to index level? Because it's actually allowed the asset manager to allocate across these kind of China fixed income performances, even compared to some of the key major asset classes.
Vanessa, could you repeat those last lines, because we had you were frozen for a second.
Yes. Sorry about that. I was saying that the China fixed income as a combo, if you think about it, the all China strategy do provide more attractive returns compared to some of the key major asset classes. Next. Other than the valuation, the attractive risk reward, I think the other key attribute for the China bonds is the low correlation benefits. The greens are actually showing the low correlation with the key major asset class, be it with equities, be it with Asian investment grade or Asian high yield, or even EM, US and Euro IG. You still see relatively low correlation between the Chinese fixed income instrument with the key major asset classes. Some of the investors may ask, is this low correlation benefits likely to stay? So far, we probably say yes, because what you have observed is that there's definitely a divergence in terms of the economic development as well as the monetary policy. China, throughout in 2020, have been one of the countries that's been coping relatively well with COVID. It's one of the first in, first out country. They also have been very careful about monetary easing as well as fiscal easing throughout in 2020. As soon as they start seeing the economy stabilize, they have been gradually go through slightly tightening on monetary and fiscal policy throughout in 2021. If any, we are at a juncture that potentially there could be some policy fine-tuning and a little bit more relaxation in terms of the fiscal and the monetary policy as we move into 2022. This is a stark contrast compared to some of the DM economy, especially as the audience would know. US have been talking about stop the taper tantrum, any potential in terms of increase of the base rate. So the divergence of the monetary policy is actually one of the key factors that we believe that the diversification benefits by thinking of China fixed income would likely to continue. Next page. Next page. Another key question we always get asked is renminbi as a currency, because of course that 3% only works if you hold renminbi as the currency, because if you hedge it back, the hedging costs could potentially be around 2%. If you're looking at the euro, it could be about 2% to 2.5%. Having said that, if you still think about hedging it back, you still get about 1%, which potentially be better than some of the single A bonds that you can hold in the sovereign countries in Europe. But the way that we think about renminbi is that, interestingly, renminbi, the government itself, when they look at renminbi, is actually what was a CFAT basket. Is the basket approach in terms of currency that renminbi has a relationship to. It's not a singular relationship. Within this CFAT basket, what you see in the top rank is the euro, which probably going to be around 20-odd%, and then US dollars will probably be around high teens level in terms of the weight, and then moving down, it will be other Asian or other countries that China trade with. But what it means is that the currency itself, if you look at it from the euro perspective, is actually quite stable. And if you even look at the CFAT index on the picture, which is the yellow one, you see that for the past 5 years, the index actually has been hovering around the 90 and 95%. Then some may ask, then why are we keep on hearing renminbi being depreciated? I think another way to consider that is that when we talk about renminbi being depreciated, a lot of time renminbi was being talked along with US dollars as well. So to some extent, the weaknesses of US dollars does have an impact in terms of the strength of renminbi itself. However, as a Europe denominated based investors, renminbi generally or historically have been relatively stable from a currency perspective as well. Okay, I will move on to the next page. So we talked about why you think about China bonds, which is the attractive adjusted returns, diversification benefits, as well as renminbi being a stable currency. So what's the latest? What are we seeing in terms of the ground? I think first of all, there's a divergence on monetary policy. There's also an increase of credit differentiation. And finally, it's going green. If we go on to the next page, what you see is, I'm afraid it's a little bit small here, so I'm going to read out a little bit. You see that there's an orange line on the left-hand side, which is the policy rate in China, and they only actually dropped 75 basis points throughout the COVID crisis, whereas if you look at the blue line, that is the Fed rate, and they have dropped close to 2% throughout in 2020 in order to ensure that they can pass through that economic downturn given the COVID situation. So to begin with, China was a little bit more cautious in terms of monetary easing. In addition, on the right-hand side, you see that they're also a little bit more cautious on the fiscal side for 2020. So China fiscal deficits for 2020 was probably around 10 to 12%, even including some of the off-balance sheet items. And for the US, it was probably closer to about 15%. So even throughout the COVID crisis, China has been careful on monetary easing as well as fiscal easing. And as I mentioned earlier on, it's one of the first in, first out economy. And as soon as they start seeing signs of stabilizing, they have been kind of gradually moving to a more tightening stance in terms of monetary and fiscal policy. And they are at this moment also going through some regulatory changes as well. And ultimately, the aim here is to aim for more sustainable growth in the future. It will potentially be slower. You're probably not going to see high single-digit growth for China going forward, but you are likely to see kind of 3 to 5% growth going forward. But this will be longer term and more sustainable. And that's really what the Chinese government is aiming for when you hear about the common prosperity language that have been used by the government very recently as well. Next page. Now let's move on to credit differentiation. I think earlier on, the moderator have asked a question about the onshore and offshore ratings. So if you look at the chart, what you see is that if you look at the market as a whole, around 78%, the blue one, are actually rated by AAA. And then you have another 13% on AA plus and another 6% on AA. So literally, you think about a market that it's highly concentrated on very high quality credit ratings. So if you look at the table below, the black table below, we kind of did a very simple indicative comparison. And what you see is that the onshore rating of A will only be equivalent to single A or triple B, whereas the triple A could potentially be a triple B or double B, and then single A would put yourself into single B. So how does Fidelity look at this? If you look at the right-hand side, this is what we did. We look at some of the key issuances by amount, and then you see the blue one, which is the onshore rating. About 80%, which is similar to what we show on the left-hand side, will be in AAA, about 19% in AA, and single A around 2%. We use the same kind of universe, and what we realize is that some of the single A will, yes, translate to single A, but some of the triple B will potentially be more equivalent to the AA that we talked about, and then some of the double Bs will probably be a mixture of AA and single A. So actually, the rating category do very differ between the onshore market and offshore market. So what does that mean? What we have also discovered is that this rating differences is also picked up by the onshore investors, and some of the onshore investors have gradually been more credit specific, and they're looking at more bottom-up research, more on the fundamentals of the company, be it the business and the financial profile, other than just relying on the regulations or the top-down approach that they historically have been relying on. And if we move on to the next page, one of the key things that happened for the past couple of years is increase of credit differentiation in the onshore market. We have put together some of the default rates for the onshore market. This is specifically in the onshore market. If you look at the overall default rate, which is in the blue color, it depends on how you wanted to count it, by number of issuer or by amount. The default rate probably will be around 1% or below 1%. If you break it down by POE and SOE, POE in the yellow color, which is privately owned enterprise. These are companies that don't have any government support. The orange one are SOE, which are state-owned enterprise. These are companies that will have government support. And what you realize is that the POE default rate actually since 2018 have been gradually coming up. This is really what I was talking about in terms of increase of credit differentiation. Companies that is highly leveraged, weak cash flows, weak operations will need to go through credit event, and they will go to default situation. What more interesting is that even the orange lines, if you look at the second chart on since 2020, the amount of default by some of the SOE is also coming up as well. So what it means is that even you are state-owned, but if your fundamentals credit is not good, then yes, you still need to go through credit event. And what in effect happened on the market on the right-hand side is that you see lower quality credits, i.e. this AA plus and the AA flat, will need to pay higher cost of funding because of the weaker credit matrix compared to some of the AAA names as well. So this is what we're talking about in terms of increase of credit differentiation, the breaking of the moral hazards, so that companies who are weaker, over leverage will need to go through credit event, and at the same time they will need to pay high cost of funding in the fixed income market as well. Next page. Now we're going to the more interesting part of the market that is continued to be developing. This is the green bond market, and this is the onshore green bond market that I'm showing here. And what you see is that the left-hand side is the issuances coming out from the onshore market, which at its peak, it was around 60 billion US dollars. And then in 2020, this is around 40 billion US dollars. And what you also see is that there's the green, blue and orange. Blue are the issues that is aligned to global standards, and orange are the ones that does not align to global standards. So there's definitely an increase in terms of onshore green bonds aligning with global standards.
So, sorry, Vanessa, to interrupt you, but that means that the definition of the green in China, green bonds have a different definition, but they're still called green bonds, even though they don't fit the international definition.
Yes, indeed. So it's very interesting that you asked this question, because that's exactly what I was going to cover as well. I think that regulators and the government do realize there's a gap between how they define green bonds between the onshore and offshore market. So what the POC did with some of the other government authorities.
Sorry, Vanessa, you are frozen again. Maybe you can start again with your. Maybe you can start again with the answer that you, well, to my question. That's what the last thing we heard.
Sure. Yeah, PBOC, i.e. central bank, together with other government authorities, have launched initiatives to promote and strengthen the green market standards, the green finance market with its global peers. So the real reason behind it is that the government aimed to align the financial market with the country's climate target. That's part one. Also to raise investors and issuer confidence in the green financing platform that they provide in the onshore market. And finally, channel the capital to the green projects and the climate change projects that they have in mind. So what did they do? So first of all, they updated the green bond project catalog in order to provide a clearer scope of green projects and regulations so that it's more aligned to the international standard. So for example, they have excluded the clean coal activities in order to eliminate concerns about potential greenwashing. They've also included green agriculture, sustainable building, water conservation, and green services into part of the catalog as well. So these are only some examples, but I think the government intention is really to align the internal standards or the onshore standards with the international standards in order to provide more confidence for investors going forward in terms of integrating the onshore green market with the offshore as well.
Okay. Vanessa, because of the time, I would suggest we have a look at the results of the poll and then maybe some concluding remarks. Is that okay with you? Okay, can we have the results of the poll, please, on screen? Well, there's only two choices here. None of the option 3 or 4. It's either, well, the majority invests in bond markets because of diversification. That wouldn't really surprise you, I would say. However, the valuations you've been arguing are a good reason as well, but they are not as big as the diversification.
Yes, but I think, as mentioned earlier on, diversification is quite significant, especially if you're looking at the global aggregator portfolio. And even with 1 to 2%, it could potentially lower the volatility of your portfolio quite significantly.
Mm-hmm. And I have a question here from one of our online viewers. Is it okay if I...
Yes, please.
Why do you think that Western investors continue to worry so much about Chinese debt building up, whereas debt in the West is so much bigger and growing? You would expect it the other way around. This is
yes, but I'm really happy that the participant pointed this out. If you look through some of the recent data, you'll see that a lot of the monetary easing have resulted in some of the developed countries having much higher debt level compared to the Chinese market. And I think the other interesting divergence, if I may, is that some of the regulations or policy tightening that we're seeing actually is really targeting in terms of the leverage. Particularly on the property sector, you probably see a lot of news regarding some of the individual names on Bloomberg But I think from our point of view, we think it's actually a healthy mechanism, i.e. the Chinese government is really trying to hone in excessive leverage in the system, and property sector is one of them. And ultimately, for the longer term, it will bring more sustainable and stable growth for the property sectors, as well as healthier issuer from the property sector as well.
But would you also think that has to do with this issue has to do with the maturity of the Chinese market?
I would probably say yes, and I think that's a very fair comment, because as you can see in the introduction part of our presentation, we talk about how fast the market has been growing for the past decade, right? Every 5 years, it's doubled itself. So historically, a lot of the issuers may need to still rely on the offshore US dollar market to fund the expansion. But going forward, they can naturally go back to the home turf and the home market, issue in the renminbi currency, and then obtain funding in the onshore market. And that opening up in terms of both equity and fixed income market also provide additional funding channels for some of the Chinese corporates as well.
Okay, thank you. I'll have a look in the room here. Are there any questions over here? People have a question they're dying to ask? No, then I think you might want to conclude with some remarks, Vanessa, at the end of your presentation about the bond market, China.
Okay, sure, thank you. So I would say why think about China bond markets? First of all, it's an ACE market, one of the largest and fastest growing. It also provides a broad range of instruments. And the third point is there's different channels to access it, as simple as just thinking about rates exposure, which give you the index inclusion, diversification benefits, lower the overall volatility of your portfolio, or you can consider an all-China strategy, which allows you to capture all potential opportunities available in the China fixed income market. I'll leave it at this. Thank you very much for listening.
Thank you very much, Vanessa. Thank you. Goed, dank u wel voor zover. We hebben even een korte pauze en we gaan over een minuutje of 10, 5 over half gaan we weer verder. Tijd voor een kopje koffie, een kopje thee en een kleine versnapering.